Where can investors now find opportunity in this market? Deepak Puri, Deutsche Bank Wealth Management CIO, joins us. Deepak, thanks for joining us. Where do you, firstly, what have you been telling clients throughout the last couple of weeks of volatility?
Right, so I was hearing some of your other guests, and I think the message isn't too dissimilar to this is panic. We don't know what we don't know. So usually the markets first, the path of least resistance is to take into account the worst case scenario. And that's really what we are seeing. Having said that, I think there's a global coordinated effort in terms of central banks and other institutions to stabilize the market reaction. And I think to a large extent, given what the experience has shown from China, that this is something that can be contained. The developed world should be able to contain it as far. And given that scenario, we think that the worst in the U.S. might be the second quarter, and after that, things might start to look a bit better. So with that prognosis, the idea would be to stay calm, a bit more cautious than usual, a little bit elevated level of cash. Having said that, don't shun any particular asset class, be it equities or bonds, and stay, course correct when time be. Be a little bit more nimble than usual.
How do you think this is only a second quarter kind of phenomenon? How do you put a time frame on it when it seems like that's a huge unknown?
It is an unknown, but my point earlier being that in China, let's say publicly it was disclosed in early January. This was going on for a couple of months. And as of today, we start seeing the numbers coming in terms of the number of
millions of people.
Correct.
And we haven't even started testing in some states.
I don't disagree with that. But my point being that maybe the fact that we are rated number one in terms of our pandemic, readiness, that should come into play. Our healthcare system should be more stable. And so, the idea would be that this is not, we don't know, as I said earlier, what we don't know. But other cases have said that if dealt aggressively and preemptively, this can be a contained phenomenon.
To that point, we played in the montage there a couple of differing views on what people expect now from the central bank. Do you think we'll get another 50 basis points cut, which some people expect on March the 18th? And if we do, does that lead to a big jump in US equities, or are markets already expecting that?
I think the bond market has sort of forced the Fed to act, and they will. The preemptive insurance cut we saw earlier this week, and I wouldn't be surprised, at least history has shown that when there's an intermeeting cut, you tend to have another cut in the regular meeting. I think it's a toss-up between a 25 bip or a 50 bip rate cut, but it's there. Having said that, I think the market is looking and is wanting to hear more from the administration side. So you would like to see some sort of think of Katrina 2005, 2006, think of Sandy 2012. There was a massive spending effort, a spending bill, not $8 billion bill that we saw pass, but in the magnitude of $50 to $100 billion. So something of that nature, maybe tax credits, maybe some sort of industry intervention, be it airlines, entertainment and so forth. So a more targeted approach. So this needs to be, dealt with in various forms. And monetary policy is just one. And I don't think the markets are too impressed with just monetary policy reaction.